Good day, everyone. Today we're going to learn the preparation of financial statements and capital statements. Preparation of the financial statements. Financial statements show how business entities communicate their stories about their financial situations. There are four basic financial statements every business must prepare. Together, they represent the profitability and strength of the company. The financial statement that reflects a business profitability is the income statement. The statement of owner's equity or capital allows or shows the change in equity or capital between the beginning and end of the period. The balance sheet reflects a company's solvency and financial position. The statement of cash flows shows the cash inflows and outflows of the business over a period of time. Financial statements are prepared in the following order: income statement first, then capital statement or statement of owner's equity. This is for sole proprietorship and partnership, and we call it a statement of retained earnings for corporations. The third is the balance sheet, and the fourth is the statement of cash flows. Let us go back to the basic accounting equation where asset is equal to liabilities plus capital, where capital is equal to beginning capital plus additional capital plus net income, which is equal to revenue minus expenses and then minus drawing. Note that the red accounts are for the balance sheet and the blue accounts are for the capital statement, and the brown accounts are for the income statement account. Therefore, the balance sheet, the formula is assets is equal to liabilities plus capital. The capital statement is equal to beginning capital plus additional capital plus net income or minus net loss minus drawing. So the income statement account consists of revenue minus expenses. So from the basic equation itself, you will find almost all the financial statements. The only one that is not found in this basic accounting equation is the statement of cash flows, because the statement of cash flows was required only in 1984, and this cash flows will come from the analysis of the ledger account of the cash. So all the details in the cash ledger will be analyzed to come up with the cash flows statement. So the cash flow statements will merely show the ending balance of the capital ledger, but how these activities using cash will be classified will be shown in the cash flow statements. So the cash flow statement is the only financial statement that cannot be found clearly from the basic accounting equation, but the details can be found from the cash ledger account. So the heart of the accounting cycle is the preparation of the financial statement. So we will begin with the preparation of the income statement. There are two types or format for the presentation of the income statement, but in our discussion, we will discuss only the two commonly used formats: the single-step format and the multi-step format. So the single-step format of income statement presents information in a simplified format. It uses a single subtotal for all revenue items, line items, and a single subtotal for all the expense items. So to come up with your net income. A single step format is not um, heavily used because it forces the readers of an income statement to separately summarize subsets of information within the income statement. We cannot deduce any analysis from this kind of information. This format is most commonly used by businesses that have relatively simple operations with few line items reported. Smaller businesses may start reporting their financial results in with using single step income statement format and then switch to the multi-step format once their operations become larger and more complex. So this is the illustration of a multi-step format. This format uses subtotals for the gross margin, then operating expenses, and non-operating expenses. This approach is used when there are many line items, thereby aggregating information for easier comprehension. This is also called classified income statement. So let's learn how to prepare the income statement. Regardless of the format being used, the steps necessary in the preparation of the income statement will be the same. The worksheet is to be prepared as illustrated in the second stage of the accounting cycle, where adjusted trial balance is prepared. Let us go back to the worksheet being prepared for the Terimacore drugstore. We stopped discussion on the worksheet so as not to confuse you on the stages of the accounting cycle. Although the worksheet is prepared in one sitting and all necessary data can be taken from the completed worksheet, the complete worksheet of Terimacore was not presented in the discussion of the recording of internal transactions and preparation of adjusted trial balance. To give focus on the preparation of adjusting entries, posting to the ledgers, of the adjusting journals, and the preparation of the unadjusted trial balance. Here now we're going to complete that worksheet of Terimac Drugstore. So, external transaction plus internal transaction is equal to adjusted trial balance. So we stopped from this discussion in the first, on the preceding lesson. So, we'll review this again. So this is the end of our discussion. In the previous lesson, we were done with the adjusted trial balance. An adjusted balance plus adjusting entries is equal to adjusted trial balance. Now, we're going to draft for the closing entries. The preparation of the closing entries should have been the next step in the accounting cycle. But the preparation of the closing entries is delayed until the final financial statements are prepared to make sure that when closing entries are made to the books of accounts, there would be no more adjustments that will entail instead of making necessary adjusting, instead of making make the post closing entry, instead of making the closing entries in the journals and posting them to the ledgers, this procedure is delayed until final financial statements are prepared, because there will be some adjustments still during the preparation of the financial statements. And if we're going to record the closing entries to the books of accounts right away, we might be ending up erasing some of our closing entries to give way to a more accurate financial statement. So, because some of the regulatory, the target of the preparation of the financial statements is to comply with the regulatory requirements of the BIR and Securities and Exchange Commission. So once these financial statements have been presented to the BIR and Securities and Exchange Commission, meaning to say the financial statements are already finalized, then the closing entries can now be safely entered into the books of accounts. Although in the process of preparation, it is logically this is logically sequential if you prepare first the closing entries, but it is not practical to do because there are still the financial statements are still subject to the approval of the regulatory body. So in theory, the preparation will be an adjusted trial balance, adjusting entries, adjusted trial balance, then closing entries. But in practice, we do not we leave the closing entries on the worksheet while we are preparing the financial statement until the financial statements are finally submitted to the regulatory bodies to make sure that whatever we're going to record in the books of accounts, that will be permanent and final. So what is then closing entry? So from the adjusted trial balance, we're going to post or to plot the closing entry for each affected account. A closing entry is a journal entry made at the end of the accounting period. It involves shifting the adjusted balance of the temporary accounts to the income statement account by reducing these balances to zero through the use of a clearing account called income summary. So it is shifting the adjusted balance to the income statement by reducing the balances to zero. So our target is to make that balance zero. First, we identify the temporary accounts. Second, we reduce the temporary accounts to zero using the income summary account. So we have discussed earlier that the formula for income is revenue minus expenses. So these are the accounts falling under these titles will be considered temporary accounts. So we're going to find out one by one which are the revenue and expense accounts. So we have here sales. Purchases have been closed already by the adjustment. So salaries expense, rent expense, utilities expense, bad debts expense, allowance for bad debt is not. That is a contra asset. Supplies expense, insurance expense, depreciation expense, accumulated depreciation is not. That is a contra asset account. So the purchase returns and allowances has already been closed in the adjusting entry. So we have freight out, transportation expense, prepaid rent asset, prepaid utilities. Then we have cost of goods sold. So after identifying all the revenue and expense items, we're going to reduce them to zero. So how are we going to reduce these items to zero? So we're going to use the income summary account. The income summary account will be the clearing account. Clearing accounts are used to record transactions on a temporary basis until it's time to post them to a permanent account. So all sales and revenue accounts to be zero must be debited, and the income summary account will be used as a credit. To make all expenses zero, the income summary account is debited and each expense item is credited. Whatever is debited should be credited, and what has been credited should be debited to make them zero. The difference in the income summary account will be either net income or net loss. That is why it is called income summary account, because we can get the difference as an income or a loss from this summary account. So let's take a look here. Take a look at the presentation here. So we're going to the sales. The sales is a is a credit. So to make it zero, we have to debit it and credit it to the income summary account. So we're going to have an entry of debit, sales, credit, income summary account. So it will appear in the income summary account on the credit side. It has been removed from the credit side of the sales account and transferred to the income summary account. Now with regards to expense, the individual expense account will be credited, and the income summary account will be debited. So the total of these expense items, which is 104,738, will be debited debited in the income summary account. It is debited in the individual expense account, but the total will be debited in the income summary account to make those individual debits zero. So we have the sales as a credit in the income summary and the expense debit in the income summary. So when the debit is greater than credit, it means to say that expenses are greater than income, because what's in the debit in the income summary is the total of expenses. And when the credit is greater than the debit, there is net income, or the sales is greater than the expenses, because the sale is in the credit side of the income summary. So if the difference is on the credit side, then that is net income. But if the difference is on the debit side, then that is a net loss. Now, this is a net income. In the presentation of the closing entry section, it is put in the debit side because of our rule on balancing of accounts. We put the difference on the lighter side. So the lighter side here is the debit side, and the heavier side is the credit side. So the credit side is heavier, therefore there is net income, because net income is the represent the credit side represent sales, which is the source of income. So the 75,262 here represent net income. It was just placed here on the debit side for the purpose of balancing the accounts, meaning to say you have to present the accounts in a balanced format. That's how we do that in accounting. Like this one, the closing entries, we present this on a balanced format. Therefore, we put the difference on the lighter side. So the lighter side is the debit side. Therefore, it came from a credit side. And a credit side in the income summary account represent income. So if the income is greater than expenses, there will be net income. If income is lesser than expenses, there would be net loss. So we're going to do the same thing with what we did on the unadjusted trial balance. In the unadjusted trial balance, we record the adjusting entries. And then, after the adjusting entries being plotted, we prepare the adjusted trial balance. This time, we're going to use as the basis the adjusted trial balance. And then we prepare the closing entries. The closing entries, the purpose of the closing entries is to segregate the nominal accounts from the real accounts, because the nominal accounts will be placed in the income statement and the real accounts, or the ones that will be left after the closing process, will be transferred to the balance sheet account. So we will do the same thing. We will plot the closing entries to arrive at the post-closing trial balance. So we have three kinds of trial balance to prepare in the accounting cycle. In the complete accounting cycle, we have the unadjusted trial balance. After adjustments, we will have adjusted trial balance. After the closing entries, we will have the post-closing trial balance. So we'll take a look at the example of the drawing. The drawing has a debit balance. To close it, it's not going to be part of the income summary account. It will be directly debited to the capital account. So to make zero the drawing, we have to credit it. And so what are we going to debit? Will it be the income summary? No, it's not part of the revenue minus expenses formula. So it will go directly to the capital. A drawing will always decrease a capital account. So we're going to, the entry of the drawing is debit. So debit, drawing, credit, cash. Now we're going to record it as a closing entry. We're going to make it zero. We're going to debit the capital and credit the drawing account. So at the end of the period, there will be no more drawing account to be seen in the balance. So drawing is also a nominal account, but it is not part of the income statement. So it is partly somewhat a real account, because it will go to the capital account. Anyway, the net income is also partly a real account, because the result of the operation will go to the capital account, but they are not carried forward to the next accounting period. So they stay in February financial statement, but they will not affect anymore the March financial statement. Unlike the real accounts, the ones that will be left after the closing process, these are called real accounts, and they will be forwarded to the next accounting period. So let's look at the details of what I have explained earlier. So this is the accounts payable. Okay, this is I'm sorry, this is not for the accounts payable. It is for the capital rather. The arrow is not so perfectly aligned with the account. So this line is for the capital, and this line is for the drawing. So we will remove this line on the accounts payable. This is not necessary. So the only lines we need to understand is this Terima Core Capital and Terima Core Drawing. So this, we have an adjusted balance of a debit in the drawing account. To make it zero, we have to make it credit. So, but what would be debited will be the capital account, not the income summary account. Okay. Now we go to the income summary accounts, or the revenue and expense items that will be closed or reduced to zero. So we have the sales. So the sales account is originally a credit on the adjusted trial balance. To make it zero, you have to debit it. But where is the credit? Here, in the income summary account. So this is the process. You debit the sales and credit the income summary account. Now, with regards to the different expenses, the remaining expense account and in the adjusted balance is the, what is this one? Salaries expense. So we have the salaries expense. Then the rent expense. And then the utilities expense. Cash shortage, we have this cash shortage. Bad debts expense. And what else? Supplies expense, we have this 29. Then insurance expense 100. Depreciation expense 833. Purchase returns, no more entry on that. What is this one? Freight out, transportation expense. Then this one, why do we have salaries payable here? We have this in a adjusted trial balance, but this is not an expense, it is payable, prepaid rent. So the last item is the cost of goods sold. So we're going to see the effects of the closing entries on the accounts in the adjusted trial balance. So we have already identified the accounts to be closed. So we have the drawing here, the drawing, which is close to the capital, and the individual expense account. We have the, what is this? Sales. We debit the sales and credit the income summary account. Now we go to the next item, salaries expense, credit, because that all these expense are debit before. Salaries expense, rent expense, utilities expense, cash shortage, bad debts, supplies expense, insurance expense, depreciation expense, freight out, and cost of goods sold. So the total of all of these will be a debit to the income summary. So this one. So this debit is the total of all expenses in the income summary account. This becomes the income summary account, except for the capital drawings and capital and drawings. So this 180 and this, the total of these expenses will be on the difference in the total expenses and the total sales will be the net income or net loss. So what is the heavier side in the closing entries column? The heavier side is the credit. Therefore, the income is greater than expenses. So the difference is net income. We put, as I said, we put it in the debit column for the purpose of balancing, but not necessarily that this is the balance, that the balance is a debit balance. It is a credit balance because the credit balance is heavier than debit balance. So the balance is credit, but in the presentation here, to balance this ending totals, we have to put the difference on the debit column. So this is a credit balance in the income summary, which is a net income. Now, take note, all the zero here except this capital drawings That is the drawing. So except for this, the drawings, all the zero will be forwarded to the income statement. So take note, this is zero, forwarded. This is zero. What is the zero? That is the purchases. So what has been made zero with an amount? So let's put it that way. So this is a zero with amount. Then this is zero with amount. Oh, this is zero with amount. It is forwarded to the income statement in the adjusted trial balance. Okay. From the adjusted trial balance to the post-closing trial balance, they are removed, but they are forwarded to the income statement. They are removed from the post-closing trial balance to identify only the real accounts. So, but they are moved forward to the income statement. So, these are all the balances that are moved forward to the income statement. Take note of the income. It is again on the debit side, but that is a net income because it came from the heavier side. We just put it here for the purpose of balancing the accounts. That's all. But in your analysis, this is a credit balance. Now, so what has been left will be forwarded to the balance sheet. So we have this cash forwarded to the balance sheet, merchandise inventory at the end, supplies rather, that is supplies or accounts receivable, sorry, accounts receivable. Then we have the merchandise inventory, then the supplies, then prepaid insurance, accounts pay, what else, trucks, this is trucks, then we have the accounts payable, then the capital, then we have the uh, allowance for bad debts, then allowance for depreciation, then salaries payable, we have this prepaid rent, then prepaid utilities. So these are the real accounts. So it should be balanced because asset is equal to liabilities plus capital. So it's a beautiful story of operation. So because it has a net income of 75,262 when the original capital is only 25,000. He started with 25,000 and it ended with how much is the capital at the end of the period. So it become 100 plus 100,000. So it is a good story of Terimakor Drugstore to present in the income statement. So let's take a good look at how the worksheet would appear after all the transaction. Isn't it a beautiful story of a business operation? So financial statement tells a story about the business operations, about the business strength and weaknesses. So it's like a photo of a person. A worksheet is like a photo of the business entity. Also, this is the picture of the Terimakor Drugstore on February 28, 2020. So there are two kinds of income statement presentation or format, and here is the presentation of the income statement using multi-step financial statement, multi-step income statement. So we presented the sales of Terimakor 180,000, then the cost of sales we arrived at the gross profit from sales. And then we compute individual selling expenses. We have the freight out, bad debts, and depreciation expense to come up with our selling expenses, total selling expenses. Then we have the salaries expense for administrative employees, then supplies expense, insurance, utilities, and rent expense to come up with our administrative expense. So we have this other expense, which is the cash shortage. We cannot classify either as selling or administrative. We put it in non-operating or other revenue items. So we have three kinds of income here. First, we have the gross profit from sale, or the income from selling, and then the operating income, the income from the operation, how we manage the business, and then we have the net income, the total income we have earned during the period. Okay, it includes non-operating income. So for presentation purposes, we have this single step. So in the single step, you only have the revenue and the total of all the expenses to come up with your net income. This is a $2 photo of the Rimacore drugstore. So it does not present much information except the total revenue and total expense. You do not know how much was the cost of selling and cost of operating. The single step format is not heavily used. This format is most commonly used by businesses that have relatively simple operations with few items to be reported. So this is not a preferred form of presentation because it does not offer much story to the reader. It's just like saying someone died. That is the story. Someone died. That is the single step income statement. But once you make a story a bit more interesting, you say, someone died, but he was hospitalized for 6 months and then he was able to recover for a little while, but finally he succumbed to his death. Then that becomes a more interesting story, and that is a multi-step income statement. How to prepare a multi-step income statement? First, you have to select the period to report. For our case, we have selected the February 2020 operation of the Rimacore drugstore. Then, write the income statement header. We have the income statement header natin is the name of the Rimacore drugstore, then the income statement, and the period for which the income statement was prepared. Then, we compute the total of all operating revenues. Then, compute the total of operating expenses. We calculate the gross profit by subtracting from sales the cost of goods sold. Then we calculate the operating income by deducting from gross profit the total of operating expenses. And then we deduct from operating income other non-operating expense, which is the cash shortage. If it has other non-operating revenues such as interest on bank deposit, that should be included in this item. Then we arrive at the net income. So we have to be computing first for the gross profit from sales. Then to arrive at a net income, we will reduce this by the operating expenses, and then other expense and income items will be the adjustments to the operating income to arrive at the net income. Let's compare the different the income statement for the different business activities. So the business activities vary according to the the income statement vary according to the business activity. In here, we illustrate a simple uh, income statement because the nature of the business is service business. So when the activity is less complex, the income statement is less complex too. So it is service activity only. Therefore, the presentation of income statement is much simple than the merchandising business, because in the merchandising business, you have to compute for the cost of sales. So that will include a lot of details to include in the financial statements. Then the most complex is the manufacturing business, because you have to show the cost of goods manufactured. When you manufacture, you have three items to include: the direct materials, direct labor, and factory overhead. It's unlike the merchandising business, you only have to compute for the cost of sales, meaning to say how much is the cost of purchasing the goods to be sold. But in the manufacturing, you have to compute how much is the cost to manufacture what has been sold. So manufacturing has so many costs involved. This is the difference in the presentation of financial statements on the different types of businesses. So this is for the service business, so simple. And then this is the merchandising business income statement, a little complex. And the most complex is the income statement for the manufacturing business. But for me, I prefer the manufacturing business because it is more challenging. Not necessarily mind-breaking, but it is challenging in a way that you have to gather so many data to come up with a good presentation. Okay, we'll go to the details of the income statement of. So we're going to change the title of the business. Instead of Tarimacore Drugstore, we'll use Tarimacore Bicycle Rental Business because it is a service business. So to come up with a service business, with this kind of income statement, you have to have a business on service. So service revenue, that is the account for the revenue. Then discounts, you have the net revenue. Less cost of services. This is the counterpart of cost of sales. Then you have your expenses to come up with your operating income. And other operating income, you arrive at other operating expenses. You arrive at the net income or loss. Then you deduct the income tax. That is another expense after the presentation of the net income. That is your net income for the period. So this illustration has a provision for income tax. So here is the income statement for a merchandising concern. So a little longer, a little bigger than the service business because there are so many things to compute. You have to compute for the cost of goods sold. You have to present the beginning inventory, the purchases, and the ending inventory. But the same, you have the same accounts for the expenses and other items on the operation, non-operating items. Now we go to the manufacturing business. This is too complicated to look at. You have to compute for the cost of goods sold. But it's not only about purchases, it's about the direct materials, the direct labor, and the factory overhead. So you will come up with the work in process inventory and finished goods inventory to compute for your cost of goods sold. So the same expenses, you maintain the same expenses as with service and merchandising, but the activity in the production of the goods is quite complex. So that ends up our discussion on the preparation of the income statement. I hope you understand how an income statement is prepared. And if you are learning from this presentation, please don't forget to like, share, and hit the subscribe button for the latest updates on this channel. Thank you, and I hope that you will continue to watch more of my videos. The next will be the presentation of the balance sheet, capital statement, and cash flow statement. I hope you will be with me in the discussion of this topic so that your knowledge and information about the accounting cycle will be complete. God bless, keep safe until we meet again in the outside world. Thank you.